Hello, my name's Joseph Graff. Before I get started with the video today, I want to tell you all that this video is just one part of a 500-part series where I analyze the 500 largest companies in America. If you enjoyed today's video, I'll include some links in the description below so you can check out my other stock analysis videos. Also, if you enjoyed today's video, please hit the like button, please subscribe to the channel, and please hit the notification bell so you can be notified when I post future updates. This helps the channel to grow. With that being said, I want to thank you all for watching, and here's the video. AT&T was founded in 1877, and they were originally the Southwestern Bell Company. You can actually trace AT&T's roots back to Alexander Graham Bell, who was the inventor of the telephone. AT&T specializes in telecommunications and is actually the largest telecom company in the world. AT&T is most well known for its mobile phone services. AT&T's operating segments include Communications, Warner Media, and their Latin America operating segment. Their largest segment in 2019 was their Communications segment, which was responsible for $142 billion of the company's revenue for that year. Their fastest growing segment in 2019 was their Warner Media segment, which nearly doubled its revenue from the previous year. AT&T is currently the 18th largest company in America and is valued at $207 billion. In this next slide, I'm going to show you all the company's earnings per share and earnings growth over the last 5 years. In general, good companies are able to produce positive earnings year in and year out and grow those earnings steadily over time. Large, stable companies such as Coca-Cola tend to produce positive earnings, but they might grow those earnings a little bit slower than a company like Tesla, which may produce negative earnings per share some years, but is generally viewed as having higher growth potential than a stock like Coca-Cola. In general, stocks that post positive earnings year in and year out, like Coca-Cola, tend to be considered less risky investments as compared to stocks like Tesla that may post negative earnings per share some years. In 2014, AT&T earned $1.24 per share. In 2015, this jumped up to $2.37 per share. This was a 91% increase from the previous year. In 2016, they earned $2.10 per share. This was an 11% decrease from 2015. In 2017, they earned $4.76 per share. This was a 127% increase from the previous year. In 2018, they earned $2.85 per share. This was a decrease of 67% from the previous year. And in 2019, they earned $1.89 per share, which was a 51% decrease from the previous year. Now that we've taken a look at the company's earnings per share over the past 5 years, we're going to talk a little bit about its price-to-earnings ratio, also known as PE ratio. PE ratio is simply calculated by taking a company's price per share and dividing it by the company's earnings per share. If you were trying to decide between buying shares in two different companies and everything else was the same, you'd want to buy the company that had the lower price to earnings ratio. This would be because you would be paying less for a company that is earning more per share. In general, companies that have a PE ratio below 20 are considered to be value stocks, while companies with a PE ratio above 20 tend to be growth stocks. In general, stocks with lower PE ratios are companies that investors tend to be a bit more pessimistic about the company's future, whereas stocks with higher PE ratios are companies that investors are a bit more optimistic about the company's future. PE ratio is just one small metric in the tons and tons of metrics that you can use to evaluate companies, but it goes a long way in helping you to get a baseline feel for why the company is valued at what it's valued at. As of June 27th of 2020, AT&T was trading at $29.08 per share. Their trailing 12-month price-to-earnings ratio was 14.8. To put that into context, the trailing 12-month price-to-earnings ratio of the Standard & Poor's 500 at the time of this recording was 21.6. To me, this indicates that AT&T is more of a value stock rather than a growth stock. And if you use PE ratio as the sole metric to evaluate AT&T, it may be undervalued. As I mentioned earlier, a company's price to earnings ratio is just one metric that you can use to value the company. Another popular metric is a company's price to earnings growth ratio. This is calculated by taking a company's price to earnings ratio and dividing it by the company's growth rate as a percentage. In general, companies with a price to earnings growth ratio of 1 are considered to be fairly valued. Companies with a price to earnings growth ratio above 1 tend to be considered overvalued, and companies with a PEG ratio below 1 tend to be considered as undervalued. Price to earnings growth ratio is a popular metric among investors because it takes both a company's price to earnings ratio and its earnings growth into account. These two metrics are the two main metrics that drive a company's stock price and thus its valuation. As of June 27th of 2020, AT&T was trading at $29.08 per share. This represents a trailing 12-month price-to-earnings growth ratio of 1.51. Since this is above 1, it indicates that AT&T may be overvalued if this is the sole metric you use to evaluate the stock. In this next slide, we're going to be going over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are popular among many investors because it's a way for investors to see a return on their investment in the form of cash payments. However, keep in mind that when companies decide to pay dividends to investors, that money that is returned to the investors is money that the company cannot use to reinvest into its own company. Dividend growth rate is the rate at which companies grow their dividends year after year. In general, investors like to see a high dividend growth rate as it means that they are receiving more and more money in dividend payments year after year. Dividend payout ratio is the percentage of a company's earnings that they pay out in the form of dividends. In general, companies with a dividend payout ratio below 70% have a good chance of being able to keep paying their dividend into the future and have some potential to grow that dividend in the future as well. Companies with a dividend payout ratio above 90% are generally seen as more risky and have a higher likelihood of cutting their dividend. As of June 27th of 2020, AT&T stock had a dividend yield of 7.1%. AT&T most recently raised their dividend in January of 2020 when they raised it from 51 cents per share per quarter to 52 cents per share per quarter. AT&T's average yearly dividend increase over the past 5 years has been 2%. AT&T currently has a dividend payout ratio of 14.8%, which indicates that they should be able to sustain this dividend payment in the future, and there is a good chance that they may raise it in the future. In this next slide, we'll look at two more metrics that you can use to value a company. The first that we'll look at is price to book ratio. You can calculate a company's book value by simply summing up all of its assets and subtracting its liabilities or debts. You can calculate a company's book value per share by taking its book value and dividing it by the number of outstanding shares. And then you can calculate the company's price to book ratio by taking its price per share and dividing that by its book value per share. Price to book ratio is a good way to get an idea of whether a company is overvalued or undervalued. A company's debt to equity ratio is calculated by summing up all of its debts and dividing that by the total shareholder equity. Debt to equity ratio is a good metric for finding out how much a company uses debt to grow their company. In general, companies with a lower debt to equity ratio will tend to do better during a recession. However, debt is a tool that companies can use to grow their company faster than they would if they did not have any debt. So debt is not necessarily a bad thing. AT&T's book value per share as of April 2020 was $27.43. This represents a price to book ratio of 1.06. This is definitely on the lower end out of all the companies that I have evaluated so far in the Standard & Poor's 500. AT&T's debt to equity ratio as of April 2020 was 0.75. This is about middle of the road out of all the companies that I have evaluated so far. I think AT&T would do okay even if we were to have a recession. In this next slide, we'll take a look at how the company's stock price has changed over the past 3 years, 5 years, and 10 years. Keep in mind that a company's past performance does not guarantee its future performance. However, seeing that a company has done well over the past couple years is usually a good sign and can indicate that the company may continue along that path in future years. If you had invested in AT&T stock 3 years ago, you would have actually seen an average annual loss of 2%. If you had invested in AT&T stock 5 years ago, you would now be seeing a 5-year average annual return of 2.2%. And if you invested in AT&T stock 10 years ago, you would have seen an average annual return of 7.8%. Keep in mind that this is operating under the assumption that all the dividends you received would have been reinvested into the stock. In this next slide, I'm going to give you all my grades for this stock. The first grade that I will give you is what I grade this stock as a defensive investment. This grade is simply a grade that I give based on how well I think a company would do during a recession, as well as how confident I am that the company will continue to generate the same or greater earnings over the next couple years. The next grade that I will give is a growth grade. This grade indicates how I feel about the company's growth potential over the next 5 to 10 years. The third grade that I will give is the company's value at its current price. I'll take a look at what the company's price is at the time I recorded this video and give you all my opinion on whether I think it is undervalued or overvalued. The last grade that I will give you is an overall grade. This is a grade that looks at this company as a long-term investment. This grade indicates how comfortable I would be with holding this company for 10 to 20 years. As a defensive investment, I gave AT&T stock a B+. I feel like cell phone service is more of a necessity than a want nowadays, and I don't see why AT&T couldn't maintain their current subscriber levels and continue to generate consistent earnings here in the near future. As a growth investment, however, I gave AT&T a C-. I understand that there is some opportunity for growth with the new 5G that they're rolling out, but I really don't see them increasing their subscriber count and thus their earnings very much here in the near future. As for the value at the current price, I gave AT&T a B+. While I'm not thrilled with the growth prospects of this stock, I do really like its dividend yield, and it does have a pretty low dividend payout ratio, so I think it may be an intriguing investment at these levels. As an overall investment, I gave AT&T stock a C. Personally, I like Verizon stock a little bit better as a telecom company, and while I think AT&T will do pretty well over the next couple years, I'm just not thrilled about them as a long-term investment.